comes the money.
Here we go. Money talk.
Here comes the money.
Good afternoon, good morning, good evening, good night, depending on where you're listening from. Welcome to another episode with Peter Kaleski and Hovig Evanian, guys. Thanks for coming back. Pete, we love doing these.
Thanks,
we love
Hov.
them. Every time I think it gets more and more fun, but beneficial to our audience because what we deliver here is unpacking and unboxing and educating people on things that, for me and you, we see every day of our lives.
Yeah.
And over the last 20 years in the industry, we've been brought up with it. But everyday Australians don't seem to pick up these concepts, and the main reason is they just haven't been taught in school, in university.
Yeah.
Like, I believe I've had a better education growing up with my family, my folks, and my surrounding sort of peers and colleagues than I have from, accounting, economics, finance, planning, master's in financial management, all these degrees. I haven't learned any of this stuff.
Yeah.
Now, obviously, there is things where there's technicalities, but that's where we come into play. So if you need your car serviced if you need the oil change, is what I'm trying to say. You don't go and try and do it yourself. You might, Peter, but you normally take it to a mechanic. But anyways, enough about that. What we're going to talk about today is, Peter,
basically the real cost of a mortgage.
Real cost. What does that mean?
Well, basically, when you need to look at how much you borrow plus the level of interest that you're going to pay over the lifetime, and how much that really adds up to be. Together.
Oh, Pete, I forgot. That's one of our clients, but that's general advice only today. Anything we say, I'll do. Don't go and implement it without getting proper advice first, but proper advice first, because we don't take into account your personal circumstances. I don't think we need to say any more than that.
Basically, I think people understand that are listening that, obviously we don't know this situation. So we don't know if the things we talk about are going to work specifically for them. So it's general information. So basically always consider advice before you do anything.
But the true cost of the mortgage, Peter, I often say to people, how much is your mortgage? And then they say, 600. And I say, well, how much do you really owe the bank? And they say 600. I said, no. By the time you pay the bank, how much do you really owe them?
Yeah, most people don't realize.
And then that's when the light bulb goes off, and they say, what can we do about it?
Yeah, exactly right.
So you need to understand what the true cost is before doing something about it, and that's what the whole reason we're going to talk about it today.
Well, once you realize how bad it actually is, maybe then you'll be more inclined to actually do something about it. People don't do anything because they don't realize.
They go through life with the blinkers on.
Exactly right, and that's what the banks obviously prefer and hope for.
Yeah.
And you get distracted by interest rates, and a lot of the times the interest rate is definitely not the most important part. It is a factor, but it's not the most important.
Yeah, absolutely. So, look, I've got a calculator up here, and I think it's up on the screen here as well. And it's one of a suite of many calculators we've developed here through our Master Your Money course at Smart Money Wealth Management. And, of course, we're going to go through this now today to show you a real-life example of what we're talking about as far as the true cost of the mortgage. So if I'm going to just put a mortgage there, I know the average mortgage today is $642,000, but let's just put $650 for argument's sake. I think that covers off, the median sort of across households.
It'll give people a good guide anyway.
Yeah,
so.
but there's a couple of things. So the next thing is the interest rate. Now, the interest rate environment we're in today, it's quite exciting. Unlike the last couple of years where we saw all those increases.
Rising,
we're sitting here. We've had, 3 rate reductions already?
Something like that, yeah.
Looking down the barrel, people are speculating on another 2 this year.
Yeah.
I'm going to say to you, I think we're going to see at least another 1.
Yeah, maybe.
What do you think, Pete?
I'm not sure. I feel like I'm on a hold situation. I think it's not going to change. I think they're going to wait. But look,
always the pessimist.
I'm just I look at the worst case scenario basically. If you look at the worst case scenario and if you get anything better, obviously it's a bonus.
But you know what it is? Look at I'm carefree about the interest rate, Peter, because I know that if you structure yourself correctly, you can get the true cost of that mortgage and slash it.
Well, the fact is, to your point, like even if they do reduce it by 0.25% or whatever it's going to be, if that. It doesn't make that much of a difference, and you can show them in the calculator.
Actually, you know what? That's a good point. If let's say I went from
feels
5.5,
good, but it's not a game changer.
Have a look at this, Pete.
Yeah,
if I go 5.5%,
having a bit of a challenge there with the mic. Don't mess with the mic, mate. We're going to get in trouble.
They put the anyway. Let me move this.
Just slide it over.
Just go. Let me go.
Too close
Wait,
to the
let me
mic,
go.
mate. You're going to get in trouble.
You talk. So 5.5%. Wait, 5 point. If I go, my numbers lock.
Hov's clearly an amateur.
Okay, 5.5.
At the mic.
Now, what I want to show you is this. Look at the monthly repayment, $3,690 a month, right?
Hey. What rate did you use?
5.5. Okay. Now, look at this. RBA reduces rates. I've now got 5.25. 3,690. It went to 3,589. Here's $100 a month, Pete. What are you going to do with
Thanks
that?
for coming. You're not even going to realize it. It's easy to absorb.
All right.
Some people spend more than that on coffee these days, realistically.
Now I'm going to come along. I'm going to give you another 0.25% off. Right? Hit enter over here. Oh. And I got you. Where did we go from?
You went to 5%.
So I gave you another couple $100.
Yeah, okay.
All right, now you're 200. So what, 1/4% on a $650,000 loan is equating to about $100 and something dollars.
Yep.
It's not much.
No, it's not.
It's not much
It's
at all.
definitely not a game changer. Does it help? Everything helps. As you can imagine, everything that you can put extra towards the mortgage. Unfortunately, a lot of people don't do that though. They don't just leave it in there. They'll probably just basically spend it. The lifestyle creep, I think I've used it in the past, comes in, they just spend a bit more money. It's just easy to sort of let that go and not actually absorb it into your loan. If you absorb it into your loan, yes, it makes a bit of a difference. But again, as you've seen with the calculator, it's definitely not a game changer.
Yeah. Look, I'm going to leave it at 5.25.
Yeah.
I know we've seen rates now as low as 5.09. 5.22, generally speaking, all the major players who are in the game, ANZ, Westpac, CBA, all that sort of stuff. Now we've got banks like Macquarie coming out with fixed rates, trying to entice people in the fours, because that tells you that they know it's going to go lower than that.
Yeah.
So look, without all the speculation about interest rate, let's go talk about the true cost of the mortgage. So if I go to 5.25%, I'm going through life, I've got a 30-year mortgage, and I'm paying $3,589 a month. Over the life of that loan, I'm paying $642,000 in interest.
Yep.
So the total cost of that mortgage.
Does it give you a cumulative amount? There?
No, not this calculator, but another one does.
I have a calculator on my phone I can use if you like.
Yeah, but I can add it up in my head too. It's 1.292157.
Wow. So
that's a mathematical genius I am.
Good work, mate.
Quantitative business analysis. Thank you, Professor Eggleston.
Some would say it's simple mathematics. One number plus another number, but that's okay.
So look, on a $650,000 mortgage, $1.3 million.
Yep.
You're paying double. Now, the true cost of your mortgage is $1.3 million if you don't do anything about it.
Correct, yeah. Exactly.
So what can be done? Well, you can set up a proper offset account structure. You know, you can.
If you use it correctly, it can work.
Look, actually, one thing that's quite powerful, and we're going to show you you can actually see it already, is fortnightly repayments.
Yeah, exactly. So, I mean, pay more often with offsets or redraws. Whether you use an offset or you just plow your money into your redraw, the outcome is typically the same if you do it. If you don't do it, it doesn't help. Yeah,
and look, the biggest problem I have is all these repayments we're looking at are, after-tax dollars.
Exactly.
So if you can tap into pre-tax dollars to do something and divert some of your tax dollars into that mortgage, that's going to be the most efficient and effective way to pay it off.
Does your calculator show if you do some extra repayments what it does?
Not this one, but I'll bring one up for you. I've got one like that.
Catch up, Hov.
Just wait a second.
We don't have all day, mate.
Extra repayment calculator. Here you go. Oh, that was pretty quick. Just a matter of typing into it. It's a different. So let's use the same basis here. $650,000 mortgage.
Yep.
And the interest rate we used before 5.25.
Yeah. And I think if you're listening to this and your mortgage isn't sort of 5.5-ish or lower, you probably need to talk to someone because it probably should be. I mean, obviously it's subject to your situation, but
I've got something better I'm going to show you.
Okay.
It's from my property investment analysis calculator. So here you go. Here's an example where somebody's got a $642,000 mortgage, paying 5.49, paying $3,600 a month. And you can see at the bottom there, it's going to take 30 years to pay off.
Yep.
Now, if this person wants to go and pay an extra $100 a week, it does drop them to 23.7 years.
Yeah, it's not bad. 7 years, 6 points.
Not that exciting.
It's not a game changer. It's still 23 years.
And that's $100 a week every week for the next 23.7 years.
Yeah, assuming you stick to it. Exactly right.
Yeah.
Exactly.
And look, can I say what I'm going to say now, Pete?
You can say
because what I'm going to say is if this person's got $1 million home and a $600,000 mortgage, they've got $400,000 in equity.
Yeah.
That equity is sitting in the walls of their house. Imagine you had behind the Gibrock $400,000 in cash. If you use it or you don't, you still got a house there.
Yeah.
But if you're not using it, what's it doing for you?
Can I have some of that cash from that wall? Oh.
Yeah, you can. You can. It's my dad calling. Normally pick that one up. But look, if you don't use that, it's not going to do anything for you. But let's say for a second you went and didn't put the $100 a week into your mortgage.
Yeah.
You said, this $100 a week I'm going to put into an investment. And let's say you went and invested in something, right? And you went and bought this, I don't know, $600,000 property, rents for $600 a week. It costs you $100 a week to keep.
Yeah.
Well, if nothing else happens, it's not going to cost you $100 a week to keep after a couple of years because as milk, bread, coffee goes up, so does the rent.
Yep.
So in the environment we're in now, if the interest rate goes down, well, forget it. Within a year and a half, 2 years, if it is a properly structured investment,
That's the important
You'll
part.
be paying nothing.
Yeah.
And, in 10 years' time, that asset just growing at the national average doubles.
Yeah.
Sell it, make it disappear, pay your capital gains,
Yeah.
pay your agents, you'll still be able to pay your mortgage off within 10 years.
In a lot of situations. Yeah, we've seen it. We've seen
and it didn't
done.
cost $100 a week
No.
for the next 23 years. It only cost $100 a week for the next 2 years, say 5 years.
Yeah, so typically what you find, you might end up doing both, paying extra and doing the holding investment. It creates opportunity, I guess. It creates the option.
And ultimately, judging by your age, I wouldn't tell you to sell that investment after 10 years because if the cow's giving you milk, why kill the cow?
Again, it's the options. It creates the options.
Yeah, you get more options going forward. So look, at the end of the day, the real cost of the mortgage, like it or not, if you do nothing, is double, to simplify it. But the thing is you need to understand is how much tax you're paying before you pay that mortgage. And more importantly, how much time it's costing you.
Yep.
Because I know that if you wait 30 years to pay off your mortgage and you might be 50, 55, 60, God forbid 70, what time have you got then to build up for your 20-year retirement?
It runs out really quickly. Quickly. So, to your point, the sooner you start doing it, the better. And at the end of the day, obviously, your concept you're suggesting about the equity is simply called debt recycling. So basically, you're recycling out, or debt recycling or equity recycling or whatever you want to call it. It's basically utilizing that available capital that you don't even realize you have to put into other investments that ideally will pay for themselves and appreciate in value, and then basically use that capital in the future to hold on to it or sell it and pay down debt or whatever it might be. That's, I guess, a more aggressive way you could say. But, I mean, if you structure it properly, it shouldn't be that.
Yeah, and look, I think most people don't realise, and I know there's different ways and means. Like one of the ways we do it, we don't often do it, is obviously margin loans against shares and all that.
We don't really do that sort of stuff,
I was just about to say, it doesn't suit, many
most
people at all.
Yeah.
Because what if that share price goes down, you get margin called and then you've used the equity in your home. The beauty of why I use the example of property is because you might be a $600,000 property, but you don't need to borrow $600,000 over your home. Most of the loans over the investment.
Yeah, correct. Yeah.
You're only putting in the seed equity, which is the deposit and the cost. So at the end of the day, it is a very safe approach if it's done correctly. And if you have the appropriate safety buffers in place. And I think one of the big things to understand is if you do nothing, that mortgage is going to cost this much. So what's more risky, doing nothing or doing something to try and give yourself that opportunity to get into that? And if you look at the last 40 years, Peter, I know no asset just goes straight up.
No.
But if we look at the last 40 years, properties, consistently grown at 7.2% per annum. It does have cycles, but
obviously nobody can predict the future moving forward. But if you look at what the government's doing, you got population, or you got immigration coming into the country at, I guess, record rates. You've got all these other incentives for people to get into the market. What the government is doing is simply increasing demand, but not supply. Typically, simple economics, if you increase demand and not supply, what happens? Value goes up.
Absolutely.
So, is it going to be the same pace it has been the last 40 years? I don't know. But, I mean, I'd be surprised if it goes the opposite.
Yeah. Mate, the name of the game is make sure it costs little or nothing to keep, doesn't give you a headache, put it in play. Let that ship sail. 10 years later, you've built yourself an option.
Yeah.
So look, we've gone through the real cost of that mortgage first. Obviously, the tax implications of not doing anything and just using the after-tax dollars to pay that mortgage. But if you flip the bill, start using your tax, using your equity, and then look where you could end up. It's night and day. Within 10 years. Now, is this a suitable approach for everybody? No. But can this be suitable for a lot of people? Yes, that don't realise it. They're going through life and not realising it.
I think you can suit more people than they think. Just because they just hear the potential of more debt and they don't really know how it's structured. So it's important to understand how that is structured, and we can go into more detail on these things maybe in this episode or in future ones as well. But if you structure it correctly, it won't cost you as much as or nowhere near the amount of your mortgage.
Yeah.
Obviously, you've got rental assistance and tax benefits and whatnot.
Yeah, I had a client the other day. They didn't. This is probably they had a house there, worth $1.3 million, and they had an $800,000 mortgage. They're like, there's no way we can do anything. Yeah. But we went and successfully got valuations done, multiple valuations from different banks. We didn't care what the interest rate was. We cared what the best val was. We made that a reality for them. They couldn't believe it. And they got into it, and now they've come back. They're actually on their third investment within 2 short years because they eventually looked at they're like, they kind of got hooked on it. Yeah. It's like that feeling of, wow, why didn't I do this 5 years ago? And they're like, let's go do this, let's go do that. And I'm very proud of these guys. They've saved over $40,000 in tax. They've built over $400,000 in wealth outside of their home. So I'm not including the amount their home's gone up because obviously just because your investment goes up in value doesn't mean your home stops growing. Your home grows as well.
Yeah, correct. Exactly.
And as these things all grow together, the more horses you've got in that race,
yeah,
the safer you're getting.
Well, I think a recent review that I did with a couple of clients, more than one actually, but one in particular, we obviously collectively looked at all of their assets that they've accumulated in the space of the last 3, 4, 5 years. And in the space of 1 year, I think there was an increase in overall value of about 400K in 1 year. They didn't even earn that much.
Yeah. Oh, yeah. And look, I always say to people, look, this isn't going to happen every year because everything's got cycles, but every year we see it's happening over and over. It seems to be
happening. Even if it's an extra 50K, it's an extra 50K that we never had in the first place, or you wouldn't have had.
And that's simply by increasing that financial footprint, making sure that your assets are allocated in a good, safe, secure, and flexible manner, and then just letting time do its thing.
I even say, in a lot of situations, even if you have to find a bit of money to cover a bit of the cost from week to week or month to month, it's actually a good thing because it creates a bit of discipline. Most people will find money for a new car or a holiday, but they seem to not be able to find money for investments. And it's there. Well, if you look at your living expenses, I guarantee you I could probably trim 10 to 15% on a lot of people on just crap. Yeah. I was going to use a different word, but
well, look, that brings me to actually this is actually true to me as well, because a well structured investment will be negatively geared, so you get the tax benefit, but with a positive cash flow. Yeah. And a lot of people go, well, what does that mean? Well, negatively geared is when you invest in something and the cost of keeping it is more than the income it produces, so it takes money out of your pocket. And everyone's like, oh, I don't want it to take money out of my pocket. Positively geared is when the cost of keeping it is is less than the income it produces, so it puts money in your pocket. But when it puts money in your pocket, what does the Australian Tax Office do? They take it away.
Take a bit away.
And generally speaking, that kind of investment is not prudent for growth because it's usually you choose rental yield or yield in dividend yield or growth. And it's the same with shares, same with property. You got to choose one or the other. It's very hard to find your cake and eat it too. But what we do to get that imbalance and to correct that is to try and find where you get your tax benefit to cover that. So it's negatively geared with a positive cash flow. Now, you get your tax at the end of the year.
Yeah.
But I don't tell this to a lot of people because the get out of jail free card, you could get your tax during the year in your pay packet.
Yep.
But like you said, I'd rather tell them, no, guys, you just get it at the end of the year. And I tell them, we've got to get out of jail free card here, but I don't want you to use it because I want you to just, force savings during the year. When you get that big tax break, go on a holiday because you've earned it during the year.
Or put it back in your debt, in your mortgage.
Put it back in your Again,
in your
it's
debt. Options. It's all about creating options. And if you don't do anything, you don't get those options.
So if you did that, you used your equity, you paid fortnightly, guess what? You just slashed that example that we showed, that 30-year mortgage. We just slashed it down to probably less than 10 years.
Yeah, it can happen. We've seen it.
It's a reality.
We've actually seen it.
Yeah.
Yeah,
so
we had one client, Paul, did it in 3. I mean, that was an extreme example. That's not going to be everyone's situation, but that's happened.
Yeah, no, it's happened again. Luke, I've got another
client.
Yes,
okay. Yep.
I could probably give you a dozen examples of how we've made that happen a few times over and over, actually. So look, many examples of that, Peter. It's just true cost of that mortgage, understanding that, and then figure out if you can get out of that mortgage.
Yeah.
Figure out if there's another way, if there's a change you can make. Now, as always, we're here for all of our listeners to reach out to us.
Yeah.
Info at Smart Money Group, call us, tee up a quick phone call, cost you nothing. We do this for everybody that gives their time to us. We'll quickly go, yep, looks like we can help. Let's set up a meeting, cost you nothing.
Yeah, definitely.
Worst thing you walk away with, you learn something.
Yeah.
So reach out, guys, if you want to find out if something like this is appropriate for you. We're happy to spend a bit of time with you. Again, no cost, just figure out, hey, yes, it's going to benefit you. Let's do this. These are the steps.
For sure.
And you can make a decision after you know you can do it.
Yeah, and if you're not ready for that, obviously give us a follow and just, there'll be future episodes that you might get something out of. And eventually when you're ready, you can reach out to us anyway. Always happy to help.
Perfect. So get out of that boxing ring that you're in and start floating away and making some inroads into the future instead of going round and round in circles.
I'm going to buy you some gloves, Hov, with a dollar sign on the front. Seems to be his thing. Thanks for listening, guys, to another episode of Here Comes the Money with Hovig and Peter.
Here comes the money.